All right, boys, we got a juicy pod for you today. I'm super, super excited. I think y'all are going to love it. This is one that's a little bit more high level, okay? So I'm having on my buddy Sean Gunning. He is an asset manager. He manages the funds of a lot of the guys that have been on this pod. So if you are making a bunch of money in real estate or you want to make a bunch of money in real estate, you need somebody to manage all the money you're making, this is a good guy to listen to. So I'm super excited to have him on. He knows a bunch about tax planning and a bunch of high-level shit that, guys like me, we don't know yet. But this is how we find out. I'll tell you that much. So I'm super excited. I think y'all are going to love him. Before we get into it, you already know the drill, baby. This is brought to you by Renovo Financial. So if you want a hard money loan, okay, you want to start flipping or buying these betas and making them nice, hit up my man Jeremy from Renovo. All my friends making good money, they're using Jeremy. That's a fact. And if you're a landlord, you want to refinance out into some DSCR loans, Renovo makes it easier than anybody else. I promise you that. Jeremy is super easy to get a hold of, and they're going to hold your hand and make it so simple. I promise you. So, all right, everybody, let's get into it. Happy hunting. Let's go.
Can I have water on the table or no?
Yeah, I have water on the table. I got you a water, too.
Oh,
but
my man.
You were here last time. I think I still got you one.
Appreciate that.
Yeah, all good. You can have them. They don't sponsor. No, none of these things sponsor me. It's really cool. Keep the Renovo mug up there.
Yeah, that's
Renovo does sponsor.
This is your
shout out Renovo.
This is your sponsor, right?
Yes, dude. This is my number one sponsor. Renovo, they pay the bills.
I love that.
And then
Let's
go.
Good people. You got to have something that pays bills. All right, let me turn. Do you need to start one?
Yeah, Sean, move over just a little bit. Is that good? We're praying. Cool. It's already rocking, Sean. Dude, thank you so much for coming on. This worked out really well.
It did work out well. Thanks for having me. I appreciate it.
Heck yeah.
Thank you.
So what's this event you're speaking at later?
So I'm speaking at Keller Williams in Power. They have a multi-family real estate event, and I'm going to be on the panel talking from a standpoint as a investment advisor. We allocate a lot to real estate, and they want a advisor's perspective of real estate, the markets, why allocation to real estate now. And so there's going to be some really cool guys in the panel, investors in real estate, guys in multifamily, so it should be a really good event.
Oh, cool, man. All right. I'll try. What time is it at?
It's at 5 p.m.
Is it 5? All right. I'll try to swing down, but, dude, the evenings are tough for me. I'm on dad duty.
I know. You're on dad duty.
I'm on dad duty.
It's all good.
And I stay inside, yeah.
It's 5 p.m. in Philly, too, right? To get in downtown, so it's tough.
Heck yeah, it's tough. But maybe I'll break away,
That's right. The wifey can handle the kids for a little bit.
Yeah, for a little, what the heck. But then I miss out.
That's right.
Heck yeah. Well, dude, I thank you for coming on. It's funny. It's funny that we've met before.
We have.
And this whole time I thought I was about to meet somebody new. How good is that?
I wanted to have a surprise. I was like, when Jake set it up. So for those that are big on his podcast, one of my best friends is Jake Penny.
Yeah.
And Jake just did a podcast with Nick. Jake's an amazing dude, very successful in real estate, way more successful in real estate than I am. So go watch his before you watch mine. But what I will say is he was like, hey, I have this guy Nick just did a podcast. I think he would be great. Awesome. I looked you up. I was like, wait a minute.
I know this guy.
I know this guy. This is going to be great. I was here with Chase Gallagher, another good friend of mine, and he did a podcast with you. And Chase is a great dude, doing some big things in real estate. So if you're into single-family rentals, those guys are way more successful than I am in single-family.
Yeah, but you're better at managing the money than these guys.
Exactly.
That's what it all goes around.
Yeah, they want to buy Lamborghinis and private jets, and we're more about sustainable growth and wealth. So.
Yeah, that's all right.
No shade on you, Chase or Jake. So if you're watching,
tons of shade on you guys. So, bro, dude. So fill me in, bro. Tell me your story. What's up with you?
Yeah. Well, before we get into that, what's the demographics of your podcast group here?
You know what? It varies. It varies anywhere from younger people looking to get into the game or change their life or get into the game.
Okay.
And also seasoned people with a bunch of money. Because a lot of the people that I have on the pod are a bunch of seasoned dudes with a bunch of money. You know? So it's a wide variety from people looking to get into it to people that have been in the game for years and are just looking to consume content from other high performers. If that makes sense.
Got it. So, all right. Well, let's do this then. I'll talk to every one of your groups.
Yeah.
But first,
juicy.
But first, why don't we talk to the beginner just getting started?
Yes.
Because this is an area, I don't tell this story very often.
Okay.
It's kind of embarrassing, but I'm going to have a little bit of humility on today's show.
Bro, tell it.
And only my close inner circle knows about this story.
I would be honored if you told it on this.
Okay. All right. Awesome. Let's do it. So, I've been in finance my entire career. Started right out of college, got my Series in 63 investment license, and everyone says, "Hey, you got to read good books. Think and Grow Rich, Rich Dad Poor Dad." What else did I read? The Slight Edge. And after reading Think and Grow Rich, I was like, you know what? I want to buy some real estate.
Yeah, Purple Bible. I'm bought in.
Yeah. So I was bought in. I don't want to be an employee anymore, even though the majority of my income at the time came from finance.
Yeah.
And I'm very good at it. And so, hey, let's go buy real estate. And I'm the kind of guy, when I do something, I'm all in. Right.
Very, very good.
Right. I'm all in. If we're going to buy real estate, let's go. Let's go do it. So I bought my first piece of property in Wilmington, Delaware.
Okay.
And I started to have some success. And I was, hey, this is great. I installed a property manager. I got a deal. Everything I did correct.
Yeah.
And all of a sudden, I started getting rental checks.
And you're like, oh my God.
I'm like, this is amazing. I remember when it became real, I was sitting at my grandfather's 80th birthday. We're at dinner with my family. I got an email on my phone that says, congratulations from Rentwell. Your check, your deposit came in for your monthly rental. I was like, this is really cool. Mailbox money, baby. Let's go.
Mailbox money.
Let's go. So on the hubris of my first real estate deal, I got with I was networking with a bunch of realtors at the time.
Okay.
And one of my realtors, who's also a friend of mine, said, hey, dude, I think there's some great deals in Indianapolis. Great. Fly to Indianapolis, bought a deal out there, bought a duplex in Indianapolis.
Just like that?
Just like that.
That's badass. All right.
This is great. So bought a duplex out in Indianapolis. This is awesome. So now I have 2 rentals, 3 units.
Okay.
Right? Think things are going well. All is good there. And then I met this interesting guy who is a turnkey real estate guy in Philly. Okay. And his model was rent per room. Right? So a new interesting model that I haven't heard about before. Did some research. It seemed like a pretty cool thing to do. There was a lot of opportunity in Philadelphia for rent per room for things that, people that are in recovery, veterans, there's all types of really good programs for rent per room. So
you make more money that way. You definitely make more. That's right. That's why it's so attractive. You make way more money that way.
You make way more money that way, right? Instead of renting it out for $1,500, $2,000 a month, you could rent each room for $700.
Yeah.
Right. So 50% more on rent per room plus. So I bought 2 rent per rooms in Philadelphia. And we rehabbed them, and we started to get them leased and rent up. But here's the rub. I got 2 houses in Philly. I got a house in Delaware, and I have a house in Indianapolis. Well, what happens when you have 50% vacancy across your portfolio?
You cooked.
You're cooked.
You're cooked.
You're absolutely cooked.
You're stressed out.
Yeah, you're really stressed out. So what I learned is that I was basically taking my active W-2 income, and I was floating my rent because you might have bought as a deal, you still have overhead, taxes, insurance, mortgage payments, just payments for random maintenance. And because a lot of these were low income rentals, they weren't Section 8, which if I would do it over again, that's what I would
Facts.
do. I love Jake Penny's model. So if you haven't watched his yet, watch Jake Penny's podcast with Nick. It's great. But what I ended up realizing was that I still had all of these bills being stacked up with these properties, right? I was taking my active income to offset my losses, and that basically destroyed me. And because they were lower income rentals, they basically just got destroyed. So I basically had 2 years where we had a renter that would move or stop paying rent after 3 to 6 months. And we had to do the eviction process. They would destroy the property. We have to, rehab it, put, tens of thousands of dollars back into it to get it to where it needs to be. I was taking out short-term debt to cover those costs for renovations and minor rehabs. And it just got to the point where it ended up becoming unsustainable from a standpoint of I was working full time and at the same time trying to build a real estate portfolio. So what did I learn, right? Number one, real estate is not passive.
No, it's not that mailbox money like you thought it was.
It is not mailbox money at all, okay? I learned that really quick. The second thing is that I took out too much debt for the type of property that it was, and I should have sold these properties sooner instead of pouring more money into them, because the economics from a standpoint of rental income did not work with the amount of debt that I had on these projects. So I actually was underwater because of the level of turnover that I had, right?
Facts, okay.
So that hurt. And I also didn't really have a strong team behind me. I had a lot of great people that I knew were good in real estate, and I had a lot of mentors, but I just never asked for freaking help. I wanted to do it all on my own. I wanted to be like the man, the guy that, I did this, and this is my portfolio, and this is what I did. But I had, one of the leading property management companies in the area, Rentwell. Like, I'm best friends with the owner of the company, Rob Coldwell. I think he'd be a great person for your podcast.
Oh, you should link me with him. I'd love to have him on.
Rob is great. Jake Penny was a good friend of mine at that time, and he was like just getting involved in real estate. But I just didn't want to. I was going to all these dig meetings and soaking up information, but I wasn't actually networking with the people that were doing the thing.
Okay, right. You weren't being like, yo, Pops, you need to help me with this.
Exactly. So I really wasn't leveraging on a team. I also, for those rent per room houses, I think one of them was more of a handshake deal. So when it came time to selling the property and to doing the closing and to figuring out like where things are going to go from an accounting standpoint, I really didn't have an agreement in place. The property wasn't my name, but this individual was doing the construction, the rehab, and the work, but I had no contract to go against work that really wasn't completed. So didn't get stuff in writing, tried to do it on my own. I had a big ego because I had success up front, and I really had to take it on the chin. And from a single-family rental standpoint, I did not have success in real estate, but my belief is you never fail. You'll either win, learn, or grow.
Okay, I like that.
And it really was a learning experience to me to really take a step back and look at, from a structural standpoint, what do I need to do going forward in order to have success in this world? And I think that's where maybe I can help those that are successful in real estate or those that have broken into real estate. My pivot has led me from looking at not short-term, but from rentals, low-income rentals, and basically building that portfolio all on your own to, hey, how can we do this at a institutional or an accredited investor level?
Oh, wow.
And how can we find the right deals to put people into to have the best possible result? And that's basically what we do now. So basically that opportunity led into me leveraging real estate for a lot of clients because we believe it is the single best asset that people can get access to in their portfolio. And I can explain why in a little bit, but that's really the genesis of the journey. I don't really tell people too much about I took it on the chin pretty hard. I ended up selling my portfolio, paid down all my debt, and really had to lick my wounds for a little bit before I could really get back into the game.
Yeah, I bet. Oh, man, that'll take you out, my boy. That'll take you
absolutely.
out. Renting by room in Philly, if I tried to do that, I would be in jail. How crazy that? You have to have the thickest skin in the world to do that. Because the type of people you're renting out to, they're all crazy. A lot of them is handshake deals, and it's all crazy scenarios.
It's pretty wild scenarios.
Yeah.
So I do not want to venture down to the rent per room in downtown Philly anymore.
Hey, God bless you, though.
That is not the vibe anymore, for sure.
No. The guys that I know that are able to do that well, these are special, man. Yeah. These are special. Yeah. Oh, man, respect to anyone that can do that.
Absolutely.
Couldn't be me. God bless you.
I know one person that's doing it at a large scale really well, and he's a great dude. But I know that he goes through some stuff to get.
That's a cool dude. Bro.
Yeah,
that's a mad respect for him. I don't even know, but I like him.
Yeah. Len Chang, you are the man if you're watching.
Hey, God bless you. You know.
Yeah. So.
What the heck? So you manage money.
Yep.
How does real estate tie in? So tell me more about that.
Yeah, great question. So let me set the stage. Real quick on that. So most traditional advisors, and if you're a financial advisor watching this, I would encourage you to look at opportunities for your clients to invest in real estate. But most traditional advisors only have their clients in equities, stocks, bonds. The problem with a traditional equities portfolio is simply that, just some simple facts here. Yes, equities have been great for the past decade for a lot, especially tech stocks. Past decade, you're averaging about 13% a year, sometimes even more in a stock-based portfolio. However, analysts right now, just based on the current climate of where things are estimating that between now and like the next decade, or 2032, the average rate of return that some analysts are expecting is about 3% a year in the stock market, which doesn't really bode well for those that are heavy in the stock. And your traditional pre-retiree or retiree portfolio, what do most people say? The 60-40 rule, right? 60% equity, 40% bonds. Since 2022, the performance of that type of portfolio has been about 2%.
Oh, get out.
Right. So what that is doing is we're not seeing, and I believe we're not seeing in the future the same growth that we have in this current stock market world, okay? And I think that is going to put a lot of pressure on people's retirement accounts. We also have baby boomers, which is, the largest population right now is going to be retiring over the next 5, 10, 15, 20 years. And what are they going to do to live off of? They have to sell their securities, which is going to continue potentially to put pressure on the market and maybe reduce valuations over time. Now, that might be a hot take, and I would love for those that are in the comments of this, or if you want to shoot me a DM on Instagram or LinkedIn, I would be happy to field any comments or concerns on that. But why real estate can be an amazing opportunity for really anyone in a portfolio is, number one, diversification. I think it's an amazing diversification tool, right? We tell people to diversify, but all we're doing is diversifying with different companies in the stock market. Well, why aren't we diversifying with real estate as well? Also, real estate provides some protection against inflation. I think real estate can be a really cool tool to help people that are concerned about the dollar continuing to erode. Having an asset is a great way to protect against that, because real assets in inflationary environments tend to go up, which is great.
Yeah.
And the second thing, which is what I'm most passionate about with our clients, is the tax advantages of real estate. And I think that's one of the main reasons why we connected, is a lot of the work that we do at our firm is helping people create the fact pattern and the structuring in order to maximize the benefits that an individual will receive from real estate, whether that is a single-family rental, a short-term rental, whether that is a real estate fund. So there's a lot that goes into it, but from a standpoint of diversification, we love real estate for someone's portfolio, and we think it can be a great option, especially for those that are seeking income. Because in today's environment, you can't just turn income on from your stock portfolio. Yes, you can invest in dividends, and there's other things that you can do, but real estate provides an amazing way, as you know, to provide income. And there are passive options that you can get access to, real estate funds, syndications, joint ventures. There's things that people can do to get access to real estate that truly is passive, and they don't have to go through the pain and suffering and experiences that I went through trying to build a single family rental portfolio.
Facts.
If that makes sense.
Yeah, for sure. So where do you fit in with your clients then? Other than just saying, buy real estate, my boy.
Yeah. So I fit in a couple different ways. The first is a lot of clients come to us with tax problems.
Okay.
Right? They have high W-2 income. They have huge capital gains exposure. They are looking to do a Roth conversion, but they know it's going to create a huge tax impact to them. And look, the IRS code is built by business owners and real estate people. That's just how it is.
Oh, right?
So we can leverage the tax code, and through a lot of allocations to real estate, we can solve a lot of the challenges that high earners, business owners, even real estate investors, entrepreneurs, and ultra high net worth clients have, really helping to reduce their biggest risk and expense every year, which tends to be tax.
Okay.
So we can help reducing that and at the same time diversify them into an asset that kicks off income, provides tax advantages, protects them against inflation, and reduces their biggest risk every year, which is tax.
Yes.
And we leverage that through a lot of partnerships that we have at our firm with real estate developers. Private funds, private placements. There's some real estate and energy opportunities that can help offset those types of challenges that people face. And where we come in as the advisor is not just helping to place them or connect them with the right sponsor or partner or real estate development company, but also do the due diligence and help find the right opportunity based upon what that client's specific goal is.
Okay.
Right. So if let's just say they're looking to sell a bunch of stock and they're going to get hit with $200,000 in capital gains exposure, well, maybe we'll look at something that can help offset that. And a lot of times that can be in real estate as a way to do that.
Can you give me an example?
So we generally don't like to talk strategy. So for those of the firm that are watching, I do apologize. But
Fast forward.
fast forward. So opportunity zone funds are a great way to save a bunch of money for capital gain exposure.
Okay.
Now, what made this possible was the Trump Tax and Jobs Act back in 2017 basically created a program and a system in order for people to defer their capital gains until 2026.
Okay.
And by deferring their gains, it doesn't completely get rid of their liability.
Yeah, you always gotta pay. You always gotta pay to mention their own. They're gonna take it from you eventually.
Yeah, everyone's still in the IRS hamster wheel. There are some ways to get around it. We can chat about, but basically, for example, on Opportunity Zone, there's Opportunity Zones here in Philly that you can invest in, and what that allows you to do is you can defer until 26, which means you don't actually have to pay until April of 27. And with that deferral, if you hold that asset for 10 years, it obviously is tax-free. And so a lot of these Opportunity Zone funds are ground-up development. Like, think about a project like here.
Yeah.
Right? So ground-up development, let's just say it's a $100 million project. And then in 10 years, where would this place sell in 10 years? Right? It might be a 3, 4, 5x. So after a 10-year hold, you might now have a 2, 3, 4, 5x on your money that now is tax-free legally by the IRS. And what a lot of what a lot of smart developers are doing is they're buying deals in a certain way to where they're able to do a 20 to a 30% cash out refi at around the time that taxes are due. So the client stays in the deal 100%, but at the same time,
oh shit! I know what you're saying. So you're doing the cash out refi, which they don't have. You don't pay taxes on it. They take that and then they pay their tax bill. Super gangster.
So they're in the deal 100%. They're leveraging other people's money, i.e., debt, to cover the tax bill. Then they're leveraging the ability for that project over 10 years to kick off a very generous and healthy return that will be tax-free after a 10-year hold. And that property also produces income in the meantime, right? So if a project is done right, and we work with a lot of institutional partners that like insurance companies and endowments and, big firms on Wall Street and invest into as a limited partner, if we're able to get access to those types of deals for our clients, a lot of times these can be a huge win for them because they have access to tools that otherwise wouldn't have access to, and it solves not just their tax problem, but it solves a potential income problem. It solves a tax-free growth problem in the future. So a lot of really, I think you use the word gangster. It is a gangster strategy.
Yeah,
in order to help people save money on tax and offset and also that liability for sure.
Okay, I dig that.
Yeah.
So this is common for y'all to put people in.
Mm-hmm. Yeah, absolutely.
So let's say they got a heavy tax bill. Instead, they put that money into this.
Right. Yeah.
Yeah.
Pretty sweet, right?
So instead of giving it to the IRS, you could put it into this.
Yeah, and basically it's putting money back in their pocket.
Yeah, dude, the IRS is happy.
Right.
Everyone's happy. Everyone wins.
Everybody wins.
I really like that.
Yeah.
So like a guy like me and a lot of people, because I have friends that I have a lot of friends that are just flippers or they're just wholesalers. You know, they don't really want to deal with the rentals because they're in real estate all day long anyway, and they can't really they don't want to have a whole other real estate business.
Right.
And if you're just flipping or just wholesaling, bro, you paying a lot of taxes.
You're paying a lot of taxes. Yeah. I mean, any flip that you do is all active income.
Yes.
Right. So there are strategies to offset active income, whether you're a W-2 producer or not. And
yeah, what if you're not? Like, I'm not W-2. I'm 1099 or whatever.
1099.
I don't know. You'd have to ask my accountant exactly when I am. Yeah. You know what I'm saying?
Right.
Like, most of us are.
Yeah.
So we can do all the same stuff. We don't have to be W-2. I don't know much about a W-2 stuff.
No, you don't have to be W-2. You can leverage the same things. It's still, if you're selling a piece of property and it's going to create, if it's a long-term capital gain, you can use an opportunity zone fund. That would be great. If it's a short-term capital gain, which is now going to be treated as active income, there's a couple different things that you can do. The first thing that we would look at for anyone is their entity structuring. How are you structured as an entity? Because at a certain point, there might be a better structure for you that allows you to pay yourself as a W-2, and you might not be paying self-employment tax, right? So if you're a sole proprietor or if you're a single-member LLC getting paid as a sole prop, there could be self-employment tax that you're overexposing yourself to, which you might not have to, and that can be a lever of tax savings. And from my experience, not every accountant or CPA does tax planning or strategy. That is like the core of what our firm does. And although I am more on the investment side, we work together as a team in order to elicit the ability for someone to reduce their taxable income. And with that savings, if they want to allocate to real estate or if they want us to manage it for them, we obviously can. But everything stems first around creating value at the tax piece first, because again, that tends to be our biggest expense every year, right?
Facts. I tell people I have a business partner. It's the IRS, bro.
We just worked with a client, and he had to write a check for $230,000 this year, and then he hired us to help him structure for this current year. And he literally said in his intro call with us, I didn't realize this, but I just realized today after I wrote that check that my business partner is the IRS. And that, with us, it's tax by obligation, but not by requirement, right? Like if you want to pay tax, that's fine, but there's things that we can do to help you reduce it as much as possible.
Yeah. That are up to code, but you need to get with people that know all the stuff.
That's right. So we work with a bank of CPAs. We have, partners that have been in this business for 20 plus years. I by no means am trying to come off as an expert. But I've been in this space.
Well, your firm in general is an expert.
So our firm in general is an expert. So, I try to, do fun things like this to not just get the word out, but also like it's my fiduciary responsibility to help people. And if we don't tell people what we do, then I'm actually failing the public by you giving more money to the IRS while you can keep it in your pocket to help you and your family
make more money to
have a better financial outcome for you and your family going forward, for sure.
Okay. Entity structures, so a lot of guys that I know, they're just, they just got a regular single member LLC, myself included.
Yep.
Is that horseshit? Does that not even do anything? Because I am paying the self-employment tax, I think. I don't even know. I'm so financially illiterate. I got my guy Charles. He says, Nick, this and this and that shit, Charles. All right, whatever you say.
Maybe me and Charles need to have a conversation about
probably.
Situation, there's things you can do, for sure. Single-member LLC is fine because it provides a layer of protection, right? So if something were to happen, you flip a property, you get sued, whatever, they're not coming after Nick personally, they're coming after the business.
Yeah.
So there is a benefit to structuring it in an LLC.
For tax purposes, though. If you're making net more than $100,000 to $200,000 a year, I mean, I don't know, this isn't financial advice, this isn't a blanket statement. It might make sense to look at changing your structure, maybe to an S corp, or maybe to a corporation. Oh, wow.
Because from a tax standpoint, there could be a benefit to not paying that self-employment tax, and structuring yourself away from that could open up some trap capital from the self-employment side.
Okay, you know what? He told me that we should make it an S corp. Actually, he said this before. Then, okay. So that maybe my guys are right.
Yeah,
Charles, I'm gonna keep you friend.
So
now.
Charles, you're doing good. See, keep it up. I like it. But that could be one simple strategy to help you save on tax. There's also investments that you could do either in real estate or in energy, and some other things. We call them tax advantage alternative investments. That's not traditional stocks and bonds, and I'm not talking about a REIT either, a real estate investment trust. Okay. Those don't do anything from a tax perspective. You could do things what we would call tax advantage alternative that would be passive, that would also allow you to offset some of your active, W-2 or 1099 income, and because of the velocity of the flips that people do, you can make really good money in flips, but it's also really increasing your tax bill as well. Right.
You paid a lot of money in taxes. They're banging us over the head.
Yeah. Nobody wants to pay more in taxes. So that's what we do now. We help people structure that, structure their tax bill away, and find great assets and investments first for them to reallocate to diversify, and that also can create income in the future as well. So which we find great.
Man, people like.
Yeah.
How did you get into this?
That's a great question. So I started my career, like I said, fresh out of Penn State. I went to a large financial management company. I was helping small, mid-sized businesses set up 401ks, retirement plans.
Cool.
So I was still in the helping people save money in tax. It just was kind of a different
realm.
A different realm.
If that's the right word.
And it was perfect word. And it was one specific product. It was retirement plans for business owners versus all, now we can do a whole bunch of other
Now you
things.
do full comprehensive, individualized planning.
Exactly. And hey, if you're a business owner, you could do a retirement plan for yourself that will help you save money on tax. SEP IRA, 401k, solo 401k. There's things that you can do for yourself in order to, if you believe in those types of products, in order to offset, But
I do and I don't, because maybe you have to tell me if I'm crazy, but this is how I look at it. I don't pay taxes now, so I can pay, and I can't touch this money until I'm in my 60s,
right.
And my taxes are going to be way more then. That sounds like a tax ticking time bomb.
It is a tax.
It's not very interesting to me.
Yeah.
Call me crazy.
No, you're
saying I can't touch this until I'm in my 60s? Don't think so.
Yeah, no, you're not crazy. We as a firm, we don't have a policy against retirement plans, but we would say that you're still in the IRS hamster wheel. And
I like how you said that again.
And you're not. And think about this, right? You would never give the IRS to manage your money, right? But in a 401k and a retirement plan, that's exactly what you're doing. You're not only allowing your money to compound, but you're also allowing the IRS's money to compound as well. I think it was the single biggest tool that the government, the IRS, and I know the IRS didn't create this vehicle, but I think it's the single biggest tool that the IRS actually looks for as a means to generate income, because they know that people continue to put trillions of dollars in these policies, and they know that in the future they have this number earmarked for tax purposes. And the problem is that from a control standpoint, a couple years ago, the IRS stopped what's called the inherited IRA. I'm not sure if you're familiar with that. I don't want to get too deep in the financial weeds here, but basically, all I'm trying to say is that the U.S. taxpayer with these products ends up being unfortunately, an increased target for the IRS and the government, especially as the national debt continues to increase. So, look, you have a finance guy that's been in the business and that's sold these things, that's been in the business for over a decade, almost a decade now, basically telling you that, if you're not into it, that's okay. There's other things that you can do to help you and your family for retirement, right? But going back to that, I basically grew that book of business to about $100 million in assets under administration. So I had a lot of success in that world, but I realized a couple of different things. The one was that it was the firm's clients, not my clients. So I was building this big book of business for them, not for me. And not for me and my family. And then the second thing I realized is what you talked about. I became a little bit disillusioned with the idea of parking your money until you're 60. And it could be great. It could be a great way to for forced savings, but at the end of the day, it's not the end-all be-all strategy, and that's kind of the way that it can be sold or presented to people as like the only thing that they can do to save on tax. So I really was on this mission to help people in other ways save on tax, and I made a little bit of money on my end in the crypto space, and so I was actively looking for things to offset my taxable income as well. And at that time, I actually was in process of building a Bitcoin mining fund, raising money to mine Bitcoin at that time.
Cool.
And it was very cool. And one of the advisors on the fund basically was a partner at the family office that I'm with now. Okay. And when we had a conversation not to finalize the Bitcoin mining fund, he basically said, hey, why don't you come work alongside the family office? You can't manage the family money, but you can learn all the strategies and the tools and the techniques to help yourself offset your tax liability, and then also you can do the same thing for your clients as well.
Yeah.
So that's how I got aligned with the teams that I'm working with now, and it's been a couple years later, and never looking back since.
So let's go. Then are you a partner in this firm yet, or?
I'm not a partner yet. I would say that I work alongside of them. I'm basically an independent.
Oh, cool.
And I get to align to whatever teams that I want in order to assist my clients in their strategy.
Very cool.
Yeah.
Yeah, I dig that. All right, cool.
So,
fun fact, a lot of people don't know that. So I used to have my series license.
Did you?
Yeah, I used to sling a ton of life insurance and annuity.
Really?
Yeah.
Really?
I had to manage money, but not a ton of managed money because I was young. I was a street kid that just passing the exams.
Yeah.
And I wanted that money right now, so I was slinging annuities and IULs.
I don't think IUL can be a cool tool if used right. Is this the first time you ever share with your audience that you had your series licenses?
Yes.
Is this?
Yeah. Well, they know I got laid off. They know this. But in 2020 happened, and they're like, Nicky, you got to go.
I love it.
I was cancer in that place. They didn't need me. I was so toxic for them to have, honestly. So it was good they got rid of me.
No compliance. You're just slinging deals.
I was crazy. You know what I mean? They said do this. I did the opposite. And people would see it anyway. It was good they got rid of me. So.
Got it. Well, you're on a way better path now. So.
Yeah. I was never going to get rich doing that because I was too nuts. But I'm the perfect amount of nuts to get rich in real estate. So it worked out really well.
One thing I did want to share with your audience, I just saw this the other day. We had a macro economic analysis done, and one of the really interesting things that we love real estate, and I think this could be really huge for your audience. Those that are new and beginning their career, and those that are really established, is we love multifamily.
Okay.
And we love multifamily for a few different reasons. The first is there is an affordability crisis in this country.
Facts.
Without a doubt, right?
Huge.
And the most recent reports, and this is nationally, right? So every different area is going to have its different variable to this. But on average, what blew me away was that on average, it's 44% less expensive per month to rent a home than it is to buy a starter home. So you're having a lot of people continue. I think it's going to be the next, the United States is Europe 2.0 right now. Everybody in Europe rents for the most part.
Is that true?
Yeah. Almost everybody in Europe rents.
Bro, I rent. I'll tell you what, because my girls always think, Daddy, we with these kids, get a house. I will, but it'll double my monthly bills.
Right.
For the house. My rent is so cheap. I don't even notice my rent check.
Yeah.
I live here. I don't care. I don't even notice. I live in a different building, but I didn't even notice it come out.
Right.
But if I get a house, it'll be
double.
It will be double with no amenities. See it.
Right. Plus maintenance.
Plus maintenance.
Plus insurance.
And
stress. And taxes. Right here, I looked up before we did this podcast. If you buy a townhome, condo, 2-bedroom, 2-bath, about 1,000 square feet, your taxes in Northern Liberty is $6,000 a year.
At least
$500 a month.
Yeah.
Your mortgage is going to be $3,000 for that place, and then you have insurance, and then you have maintenance and upkeep, and you're going to be in a beautiful place like this. You get all these cool amenities for, a couple of grand a month. It's pretty sweet.
Well, I take my grease, dump it in the drain.
That's right.
It's not my problem. I don't give a shit.
Exactly. So from an affordability standpoint, I think multifamily is great. From obviously inflation protection, we love that. Provides tax advantages for those that are actively on the management of that project and that, if you're a general partner, and then in income. So from all those standpoints, we see multifamily being a huge growth driver in this country. Obviously, some markets will do better than others for sure. But if you're getting into real estate, I would highly look at learning the multifamily game, because I think it could be huge, not just now but also for the future.
Okay, I would assume a lot of the funds that you're putting people in there are all big
multifamily.
He's not talking about duplexes and quadplexes. Right. He's talking about big stuff.
Right. But even like, there's opportunities. Some funds are going after like AI technology, warehousing. Advent of continued data and AI is driving the need for more data centers. So industrial use for that, and then also industrial use for e-commerce. E-commerce has exploded. Like 3x compared to retail over the past couple of years. So the need for what are called like short-term warehousing. So the final destination before it actually comes here to get delivered. And those can be a pretty unique opportunity to invest in.
Okay.
So e-commerce, warehousing, and data storage, AI data center storage for industrial. So yeah, we're moving into a new world, but multifamily and well-placed and industrial warehousing, I think, could be a really cool opportunity to your viewers, for sure.
Okay. And heck yeah. We're getting away from Alex. Is there anything else you wanna leave these people with and you want to talk about before we wrap the sucker up?
Yeah, I mean, the one thing that I'll leave is that I wanted to be completely vulnerable and share my experience in residential real estate. And I know when people originally get into real estate, you're looking at these smaller deals, low-income deals, just because you're trying to get your feet wet, right? And I would say that, from my experience, and I hope you guys got value out of our conversation, today, just from kind of from hearing my experience, but from my experience, I would say, look, if you're a new person and you want to do it right, find a good team. Find someone that's killing it in real estate and emulate their process. Create not just an amazing team, have things in writing, hire a good attorney, hire a good CPA, make sure that your structuring is correct. And also, like, don't be in such a rush. And this is a Gary Me philosophy, right? Like, I'm only 32 years old. My philosophy to real estate has completely changed. For example, if I bought, I did the math on one of the numbers in a Northern Liberties townhome. If I bought and rehabbed a townhome, my average rate of return after mortgage and expenses and insurance and taxes would be about 9% a year, my cash on cash return, right? Not bad, right? Only putting like 20 to 40K down, 9% a year. That's not terrible. But if I just saved up a little bit more money and I had $100,000 and I put it into a passive investment and I'm making 9-10% a year, same amount, which you can do in private funds, well, I have basically zero of my own time in the deal. I have other people, I'm leveraging other people's talents that are better than me at real estate. We have it in a fund structure which protects investors and also protects those that are managing the property. And the law of 72, right? If you're making 10% a year and you have that for, let's just say, the next 30 years, about every 7 years, you're doubling your money. So you turn 100,000 and in 30 years, you have 800,000. Just by that simple math.
And you don't have to do anything.
And you don't have to do anything. So my thing would be is, hey, look, if you're new into real estate and you want to get into it, like, hey, like, have patience and really find your lane. Find people that are doing it the way that you want to do it. Create a great team, but also be patient with the process and don't try to over leverage yourself, because that's what I did and it really hurt me in the beginning of my career. And now I have a much more passive view of real estate investing, and I have a long-term focus. And that allows me, when I'm evaluating deals, to take a step back, because I'm not going after the highest rate of return. I'm looking at things that are going to set me up for the future and that create tax efficiency in my life. Because if I'm offsetting my taxes, we're looking at total economic value, not what it's going to give me as a cash-on-cash return. And a lot of times, total economic value is going to beat the highest return projects, hands down.
Okay.
So that's what I would say. Be patient. And, you know, if you really want to get into real estate, like that's amazing. It's a great asset class. I wish everybody luck. And if you do it right, you structure yourself right, you can do well.
Heck yeah. And if you're making this money, you need someone to go to to help manage it. This is the guy to manage it. I'll tell you that much. My guy, thank you so much for coming on. All right, everybody, happy hunting.